Your retirement account just became part of the biggest financial experiment in human history. Everything you've saved, everything you've built, every dollar sitting in your 401k sits inside a system that's quietly breaking down. Not because of a stock market crash, not because of some dramatic moment you'll see on cable news, but because of something far more dangerous, mathematics that stopped adding up. January 1st, 2026, marked the exact moment this became irreversible. On that day, China activated something that sounds boring and technical, an upgraded framework for their digital Yuan, CDBC. But here's what nobody's telling you. This isn't just about China getting marginally more powerful. This is fundamentally about America's $38 trillion debt becoming structurally impossible to finance. The mechanism of collapse will not be sudden or spectacular, but rather a slow, methodical erosion of the dollar's indispensable status, a process that has already begun, stealthily eating away at the foundation of global finance and accelerating the inevitable confrontation with a far larger numerical monster, the $318 trillion number. This figure is not the national debt most people discuss. It represents something far worse: the summation of every promise, every obligation, and every contingent liability the American government has accrued, spanning generations, and demanding immediate critical attention from every investor, even as they resist the urge to panic and sell everything, because understanding this looming shift is the only viable defense against its consequences. When standard political discourse references the national debt currently hovering near $38.43 trillion as of early January 2026, they are presenting a surgically misleading snapshot of the nation's fiscal health. This figure, daunting as it is, only accounts for the money America has already borrowed, the existing pile of IOUs held by the public and intragovernmental accounts. It is analogous to an individual acknowledging only their credit card balance, while conveniently sidelining the staggering weight of their long-term, non-discretionary commitments, the mortgage on the family home, the financing for multiple vehicles, the accrued student loans, and, critically, the binding, often legal, promises made regarding future expenditures, such as college tuition funds or long-term care for dependents. In the federal context, these overlooked obligations are the true fiscal leviathan, the lurking danger that overshadows the already monumental gross debt. Specifically, the magnitude of America's unfunded future obligations is staggering and demands precise quantification to grasp the true depth of the solvency crisis. Medicare, the crucial health care program for seniors, faces an unfunded liability projected to be approximately $52.8 trillion over the next 75 years. This is not speculative accounting. This is the present value shortfall between expected program revenues and mandated payouts under current law. Social Security, the other bedrock of the American retirement system, layers another monumental chunk onto this liability stack. Beyond these two giants, the promises made to federal employees and veterans in the form of pensions, health care, and other mandated benefits contribute another $15 trillion in recognized obligations. When macroeconomic researchers and nonpartisan fiscal watchdogs calculate the complete fiscal picture, consolidating the federal government's explicit gross debt with these vast, unfunded commitments to future beneficiaries, the total federal fiscal imbalance breaches the $162.7 trillion mark. This number encapsulates the true present value of the gap that must be filled, either through future taxation, drastic spending cuts, or most likely, inflation and debt monetization. Yet, even this $162.7 trillion figure often falls short of the full societal financial burden. When one meticulously aggregates state and local government debt, which includes their own massive unfunded pension liabilities for teachers, police, and municipal workers, the total national obligation picture surges well past $200 trillion. And for those analysts employing the most comprehensive, long-dated present value calculations, those that incorporate every contingent liability, every long-term commitment, and the perpetual shortfalls projected in mandatory spending programs against baseline revenue, the complete liability picture pushes inexorably north of $300 trillion, culminating in the most frequently cited extreme estimate of $318 trillion in total obligations across all layers of government and time horizons. This colossal figure, the real debt measured properly, is the anchor dragging the American financial system toward the deep, turbulent waters of inevitable restructuring, setting the stage for the mathematics to finally seize control. This distinction between $38 trillion and $318 trillion is crucial because it reframes the entire discussion. America does not merely possess a debt problem, America is wrestling with an exponentially accelerating financing problem. Every powerful empire in recorded history, from the Roman Republic navigating debasement to the Spanish Empire drowning in sovereign debt, and the British Empire struggling to maintain the gold standard against global capital flows, shared the same fatal, immutable weakness. Their collapse, or at least the terminal decline of their global hegemony, was predicated not on external military defeat, but on the moment when the mathematics of financing stopped functioning. The moment when global lenders, whether private bankers or allied states, ceased being willing to extend credit on favorable terms. America for decades seemed immune to this historical pattern, not due to superior fiscal management, but because of a crucial, unique mechanism: the forced global dependence on the U.S. financial system, which created an automatic, relentless demand for U.S. Treasury bonds. This dominance was not initially achieved through overt coercion or military might, but through sheer, irresistible convenience and structural necessity. If a nation wished to purchase oil from Saudi Arabia, the transaction had to be denominated and settled in dollars. If major corporations sought to execute complex international trades, the clearing mechanisms invariably ran through American banks and the SWIFT system. If a central bank wished to secure liquid, trusted reserves to participate in the global economy, the only genuinely viable, deep, and liquid option was to hold U.S. Treasury bonds. The dollar was simply the best, most liquid, and most widely trusted mechanism available for storing value and facilitating cross-border commerce, effectively granting the United States the exorbitant privilege of borrowing virtually unlimited amounts at near zero real interest rates. But the foundation of that convenience fractured irrevocably on January 1, 2026, when China's upgraded digital Yuan framework went operational. The significance of this event is not that the digital Yuan is poised to replace the dollar in every corner of the globe overnight. That scenario remains fantastical. Its true danger lies in a far more subtle yet profound strategic shift. China has now successfully made the dollar's participation in large swathes of global trade optional. The digital Yuan does not need to overthrow the dollar. It merely needs to create a credible, hyper-efficient parallel settlement system, allowing key trading partners to bypass the dollar-based financial architecture when efficiency dictates. And this is precisely what the rapidly escalating figures confirm. This structural bypass is already manifesting through Project mBridge, a multi-central bank digital currency bridge that facilitates instantaneous direct currency settlement between participating nations. As of November 2025, the transaction volume surging through the mBridge platform had reached an astonishing $55.49 billion. This figure represents an astronomical 2,500-fold increase over the initial pilot phases witnessed in early 2022, signifying a transition from technological experimentation to active, large-scale commercial use. Critically, the digital Yuan now constitutes over 95% of the total settlement volume within this robust framework. This is no longer a test. It is a live, functioning alternative. The platform has successfully processed thousands of transactions involving Major economic players like China, Hong Kong, Thailand, the United Arab Emirates, and most significantly, Saudi Arabia, all engaging in trade settled directly in their respective sovereign currencies, completely eliminating the need for dollar intermediation. To fully appreciate the gravity of this shift, one must visualize the traditional settlement process. When, for instance, Thailand procured critical energy imports from Saudi Arabia, the Thai baht first had to be converted into U.S. dollars. These dollars were then routed through the intricate web of American financial infrastructure, often involving correspondent banks and clearing houses. Upon arrival, Saudi Arabia subsequently converted those dollars into the Saudi riyal. Every step of this cumbersome, slow process incurred fees, introduced settlement delays, and most importantly, for the U.S. financing model, generated a hard structural demand for U.S. dollars, forcing foreign entities to acquire and often store those dollars in the safest available format, U.S. Treasury bonds. Now, through the instantaneous finality and reduced friction of the mBridge system, Thailand settles directly with Saudi Arabia using the digital Yuan or other agreed-upon member currencies. The dollar is surgically removed from the equation. While a single transaction's bypass is irrelevant, the compound effect of millions of transactions, culminating in $55 billion in monthly volume and growing, fundamentally alters the global demand profile for the dollar, accelerating the deterioration of America's financing capacity. The mechanical crisis unfolds through a cascading sequence rooted in the rising cost of servicing the existing debt, a process currently masked by the sheer size of the U.S. economy, but manifesting powerfully in the interest expenditure figures. This first phase, the invisible debt crisis, is evident in the burgeoning interest payments on the national debt. Over the last 12 months, America paid a near trillion-dollar sum, specifically $981 billion in net interest expenses. This represents a near tripling of the cost compared to the $345 billion paid in October 2020. The principal amount of debt certainly grew, but the true driver of this explosive cost increase is the simple crushing reality of rising rates. The average interest rate on total marketable debt has jumped to 3.362% today, compared to just 1.552% 5 years prior. The cold, brutal mathematics dictates that for every 1 percentage point increase in the average interest rate applied across the $38.4 trillion principal, the Treasury must locate an additional $380 billion every single year merely to satisfy the interest commitment. This is the invisible fiscal hemorrhage that most citizens and even many commentators overlook. The annual cost of servicing the debt now consumes more taxpayer funds than the entire budget allocated to Medicare, the program ostensibly designed to care for the nation's elderly, and it simultaneously exceeds the annual spending dedicated to national defense, the constitutional imperative of protecting the country. The nation is spending more on the price of past borrowing than on its future health and security. And these interest costs, unlike operational expenditures, compound geometrically, forcing ever greater borrowing just to pay the bankers. This leads directly into the second genuinely frightening element of the financing problem, the relentless payment challenge or the need for constant bond rollover. The United States Treasury is not dealing with a static debt pile. Rather, it operates an immense financial treadmill where billions in existing Treasury bonds mature every week, requiring immediate repayment. To facilitate this, the Treasury must continuously sell new bonds into the market to raise the capital necessary to pay off the old ones, a financial maneuver akin to paying off one perpetually maxed-out credit card with funds acquired from a new one. This arrangement only remains solvent so long as there is an eager, reliable stream of buyers willing to purchase the new debt instruments. For decades, this demand was assured. Foreign central banks, particularly those of China and Japan, required vast dollar reserves for trade settlement and economic stability, making Treasury bonds the natural, necessary repository for their excess capital. Furthermore, vast legions of American institutional investors, pension funds, and money market funds were legally or prudentially required to hold large allocations of these risk-free government bonds. However, the structural demand from these critical foreign buyers is visibly eroding. Japan, historically the largest holder, now holds approximately $1.1 trillion, representing only 3.1% of the total U.S. debt as of May 2025. China's holdings have shrunk even more dramatically to $756 billion, or 2.1%. Crucially, this decline is not solely an act of geopolitical antagonism, it is a rational economic response to changing trade dynamics. When nations can execute massive commodity and trade settlements through platforms like mBridge, bypassing the dollar, their requirement for maintaining vast dollar reserves diminishes proportionally. Fewer dollar reserves mean a decreased, perhaps even discretionary need to purchase U.S. Treasury bonds. This reduction in core demand forces the U.S. Treasury into an increasingly precarious position. It must find new domestic buyers, offer dramatically higher interest rates to compensate for the reduced foreign appetite, or, in the ultimate act of desperation, monetize the debt by having the Federal Reserve effectively purchase its own bonds. Each of these three potential solutions acts as a powerful accelerant to the underlying inflation and solvency crisis, exacerbating the problem they are ostensibly attempting to solve. This mechanism of demand erosion brings us to the third critical phase, the currency bypass, a subtle maneuver that few outside of high-level financial infrastructure grasp fully. The digital yuan does not need to achieve the status of the world's dominant reserve currency to inflict catastrophic damage on the U.S. financing model. Its function is simpler: to systematically reduce the obligation to transact and settle in dollars. The cumulative statistics speak volumes about its operational success. By the end of November 2025, China had recorded 3.48 billion cumulative digital yuan transactions, valued at a substantial 16.7 trillion yuan, which translates to approximately $2.37 trillion US dollars. This staggering volume represents an 800% growth rate in just 2 years, signaling mass adoption in domestic and border regions. Crucially, China has engineered the digital yuan to possess interest-bearing capabilities coupled with stable coin-like functionality, meaning it offers stability, and the potential for a small return while retaining the ultimate sovereignty and regulatory control of the PBOC. This combination makes it uniquely attractive for cross-border commercial and infrastructural transactions. China's strategic deployment of the digital yuan into key trade and tourism economies, Hong Kong, Macau, Laos, Thailand, Cambodia, and Singapore, is calculated to build network effects. Consider a major exporter in Thailand who conducts a substantial portion of their business with Chinese manufacturers. Historically, every transaction was a costly, time-consuming multi-step process. Conversion from baht to dollars, the associated currency conversion fees, the multi-day wait for final settlement, and the double exposure to exchange rate risk, entering and exiting the dollar. Now, that same business can settle directly in digital yuan through mBridge. The transaction is instant, the cost is significantly lower, and the intermediary risk is eliminated. The Thai business does not immediately cease using dollars for every other aspect of their operation, but for that specific high-volume trade relationship, the dollar system has been permanently bypassed. Multiply this localized bypass across thousands of major commodity trades, millions of manufacturing supply chains, and dozens of increasingly integrated economies, and the aggregate daily demand for dollars begins to decline not in a catastrophic lurch, but consistently, mechanically, and relentlessly. This systematic reduction in demand, the bypass rather than the replacement, is the corrosive agent attacking the foundation of the Treasury market. This progressive erosion inevitably triggers the fourth and most perilous phase, the confidence leak. Financial markets are not linear. They price risk exponentially. For generations, U.S. Treasury bonds have been universally recognized as the world's singular risk-free asset, the foundation upon which all global financial modeling, from derivatives pricing to asset allocation strategies, is built. The yield on the benchmark 10-year note, which stood at 4.24% on January 16, 2026, is supposed to reflect the purest form of compensation for time. But what happens when the global market, institution by institution, begins to seriously question America has long-term capacity to service a debt load that includes $162 trillion in unfunded liabilities? The market understands that the U.S. will never technically default, as it possesses the sovereign power to print dollars. The true question is, what will the real purchasing power of those dollars or those maturing bonds be? The moment this confidence begins to leak, a process that always starts subtly at the margin, interest rates rise, driven not by the Federal Reserve's monetary policy decisions, but by the market's inherent demand for a higher risk premium to compensate for growing fiscal uncertainty. The 30-year note yield concluding January 16, 2026 at 4.83%, a multi-month high, is a palpable early indicator of the market beginning to price in this escalating fiscal risk. This risk premium initiates the lethal feedback loop, the death spiral that defines modern sovereign solvency crises. Higher demanded interest rates immediately inflate the cost of servicing the existing $38.4 trillion debt. More expensive debt leads directly to larger structural budget deficits. Larger deficits must, by necessity, be financed through even greater borrowing, requiring the issuance of yet more Treasury bonds. This increased supply, meeting questionable, diminishing demand from bypassed foreign actors, mandates still higher interest rates to clear the market. Once this confidence leak starts, halting it requires either a politically miraculous fiscal restructuring, which America's polarized government has proven utterly incapable of achieving, or a dramatic, painful economic contraction, neither of which is palatable. The digital Yuan, while not the root cause of America's $318 trillion problem, is the crucial accelerant, strategically removing the forced international demand that was historically the only mechanism preventing this financing spiral from spiraling out of control. The strategic alignment of geopolitical and technological forces is perfectly illustrated by the adoption of mBridge by key commodity producers. The Saudi central bank joining the mBridge platform in 2024 was a seismic event, not just a technical footnote. Saudi Arabia, historically the linchpin of the petrodollar system and America's longest-standing ally in the Middle East, is participating in a Chinese-led, dollar-bypassing payment structure. This decision is purely pragmatic. Project mBridge objectively tackles the key inefficiencies, high costs, slow settlement, operational complexity inherent in the legacy dollar system. But the side effect is massive and immediate. Every Saudi transaction settled through mBridge, particularly for oil and gas, the two sectors most responsible for generating dollar demand, reduces Saudi Arabia's need for large dollar reserves. Fewer needed reserves means fewer U.S. Treasury bond purchases. Less Treasury demand, compounded by the constant need to roll over debt, forces interest rates higher, and the catastrophic mathematics of $38.4 trillion debt at elevated rates becomes starkly visible. At 2% interest, the $38.4 trillion debt requires $768 billion in annual interest, a manageable burden within a $7 trillion federal budget. At 5% interest, that same debt demands $1.92 trillion in annual interest payments, a sum that exceeds the entire defense budget and the Medicare budget combined. This is the unsustainable precipice the United States is rapidly approaching. The sheer pace of accumulation underscores the urgency. The national debt has been increasing at an average rate of $8.3 billion per day over the past year, translating to $334 million every hour, $557 million every minute, and approximately 92,912 every single second. The question is not whether this current trajectory is sustainable. It demonstrably is not, but rather how long the market will allow this compounding instability to persist before forcing a definitive reckoning. This is where the digital yuan fundamentally matters. Every trade settlement that utilizes mBridge instead of the dollar system is one less transaction requiring dollar liquidity, one less source of structural demand for U.S. Treasury assets. While the current impact is marginal, the effect is compounding relentlessly. China's integration of the digital yuan into massive platforms like WeChat Pay and Alipay, acclimatizing 1.4 billion people to the currency's digital form, ensures the network effects will kick in hard. As cross-border trade, and especially energy and commodities, the historical pillars of dollar demand, increasingly settle in digital yuan, the mathematics of U.S. debt financing accelerates toward its breaking point. For the skeptical observer who cites previous failed predictions of the dollar's demise, the response is clear. While the historical skepticism is warranted, the current situation possesses fundamentally unique characteristics. For the first time since the Bretton Woods Agreement, there exists a credible, functioning, technologically superior alternative infrastructure for international settlement that systematically excludes the dollar. This is not a conceptual threat. It is an operational one, processing billions in real trade volume. The network is growing. The incentives for participating nations, cost reduction, speed, are perfectly aligned, and America's domestic fiscal mathematics is worsening every month. These four simultaneous conditions were never present during previous episodes of dollar doomsaying. Empires do not fail when their debt becomes maximal. They fail when the convenience of lending to them evaporates. For 3/4 of a century, lending to America was the definition of convenience and safety. The digital yuan is making that convenience optional, and the corresponding price of that optionality is a rapidly rising interest rate on the debt. This is the essence of the slow collapse, an erosion of certainty. The dollar system is not ending tomorrow, but the era of unchallenged dollar dominance is definitively concluding, a transition that demands deep strategic preparation, not reckless panic, from every individual and institutional investor. Nothing breaks tomorrow but the mathematics already broke. This realization, stark and unavoidable, compels us to move beyond the superficial metrics of the daily market ticker and delve into the hidden mechanics of global capital flow, specifically the phenomenon known as the invisible drain of capital flight. The shift initiated by the upgraded digital yuan framework on January 1, 2026, isn't about immediate seismic market shocks. It's about systematically dismantling the structural pillars of American financial dominance, the exorbitant privilege, brick by agonizing bricking. For decades, the United States enjoyed this unique privilege, allowing it to finance immense deficits and conduct foreign policy largely unfettered, simply because the rest of the world required dollars to facilitate global trade, particularly in critical commodities like oil and raw materials. This mandatory demand translated directly into a captive market for U.S. Treasury debt, suppressing interest rates below what the underlying fiscal fundamentals would otherwise dictate. The dollar wasn't just a medium of exchange, it was a global obligation, and the corresponding necessity to hold vast dollar reserves by sovereign nations acted as an automatic, infinitely replenishing credit line for the American government. Now, with the maturation of the digital yuan and the explosive expansion of Project mBridge, witnessing a transaction volume surge to $55.49 billion, settling 95% of that volume in the digital yuan, that fundamental obligation is dissolving into mere choice. This reduction in the mandated demand for dollars triggers an insidious form of capital flight. It's not the dramatic, visible flight of wealthy individuals moving assets offshore overnight, but the slow, strategic leakage from the world's most conservative institutions, central banks, sovereign wealth funds, and massive multinational corporate treasuries. When a central bank in Southeast Asia or the Middle East observes that 10% of its national trade volume is now seamlessly settling in digital yuan via mBridge, the logical conclusion is that 10% of its required dollar reserves for trade stabilization are suddenly redundant. That marginal reduction, multiplied across dozens of trading partners, translates into hundreds of billions of dollars that are no longer strictly necessary for reserve stability. These reserves, historically parked safely in U.S. Treasury bonds, must now be liquidated not out of malice, but out of fiduciary responsibility to optimize national balance sheets. This process is silent, methodical, and relentless. As these formerly captive buyers step back, Japan S holdings dropping to 3% and China S to 2.1% of U.S. debt, and those declines accelerating, the U.S. Treasury is forced to pivot to domestic buyers, and, crucially, to attract these buyers by offering significantly higher yields. This is the heart of the financing problem. The invisible drain of foreign capital immediately translates into rising financing costs for the $38.43 trillion national debt. The market doesn't need external drama. It simply requires the marginal buyer to demand higher compensation for taking on the rapidly accumulating sovereign risk. We saw the yield on the 10-year note finish at 4.24% and the 30-year note at 4.83% in mid-January 2026, numbers that signal a clear and present danger far beyond temporary inflation concerns. These yields reflect a burgeoning fiscal risk premium, a tacit acknowledgment by bond market participants that the sovereign credit profile of the United States is deteriorating rapidly. The market is whispering that the only way America can pay its debt is by printing the money, which is a soft default via inflation, or by dramatically slashing those unfunded obligations, which is a political impossibility. The consequence of this rising interest burden is a devastating compounding effect. With average interest rates on marketable debt hitting 3.362%, inching closer to the critical 5% threshold, the $981 billion annual interest costs becomes the single largest non-discretionary line item in the federal budget. Should that average rate climb to 5%, the annual interest cost explodes to $1.9 trillion. This is more than the combined annual expenditure on national defense and Medicare, forcing a grotesque reallocation of resources. The government suddenly finds itself in a zero-sum game, either cut essential services, disarming the nation, starving social safety nets, or borrow even more simply to pay the interest on the money already borrowed. This is the definition of a sovereign debt-death spiral. Furthermore, this dynamic leaks poisonous instability into the highly complex plumbing of the domestic financial system. The primary dealers, tasked with underwriting the colossal Treasury auctions every week, suddenly face wavering demand from traditional overseas partners. They must absorb more risk, pushing their balance sheets closer to capacity. This pressure ripples into critical short-term funding markets, like the repurchase agreement, repo market, where liquidity is the lifeblood of the entire financial structure. Any systemic stress in Treasury demand quickly translates into volatility in the repo market, increasing the cost of short-term borrowing for banks and institutions, which in turn tightens financial conditions for the entire economy, independent of Federal Reserve policy decisions. Simultaneously, the vast $318 trillion ghost liability, the true measure of America's long-term promises, including Medicare, Social Security, and unfunded pensions, begins to exert gravitational pull on present-day financing. While these are not bonds that default in the traditional sense, they represent massive claims on future government revenue. As the cost of servicing the current $38.43 trillion debt eats up discretionary spending, the market starts pricing in the increased probability that the government will be forced to dilute these future obligations through aggressive inflation or benefit cuts. This is the confidence leak metastasizing into full-blown institutional distrust. The slow, methodical adoption of the digital yuan provides an immediate and attractive off-ramp for capital seeking to escape this deteriorating U.S. fiscal certainty. It's the practical implementation of a parallel financial universe, one designed for efficiency and speed, fundamentally challenging the dollar's transactional monopoly in energy and commodities, the very sectors that historically sustained dollar demand. The real danger lies in the psychological tipping point of institutional mandate. Large pension funds, global insurance companies, and mutual funds are mandated to preserve capital and generate predictable returns. When the risk-free rate, the U.S. Treasury yield, no longer adequately compensates for the fiscal risk, these institutions must fundamentally reconsider their asset allocation framework. The decade-long strategy of risk parity, which depended on treasuries acting as the perfect hedge against equity risk, starts to fail. Instead of a safe hedge, the treasury bond becomes merely another risky sovereign asset in a highly leveraged global environment. This necessitates a massive systematic reweighting away from G7 sovereign debt and into two primary categories. First, productive, real assets that generate value independent of currency denomination, and second, hard currency alternatives and monetary metals that protect against sovereign credit default and currency devaluation. This repositioning is complex, often taking years due to internal governance and regulatory constraints. But once the momentum begins, it accelerates rapidly. Every institution that shifts its allocation puts further pressure on Treasury yields, driving up the cost for the next institution, creating a cascade effect. This structural capital flight manifests in a global hunt for productive capacity, the ultimate defense against currency debasement. Investors aren't just seeking returns, they're seeking sanctuary for purchasing power. This leads to massive, multi-decade flows into infrastructure projects, logistics, supply chain resiliency, and manufacturing hubs located in geographically stable and fiscally conservative nations. The focus shifts from high-growth software startups, which are essentially claims on future currency, to the tangible assets that produce the food, energy, and goods the world needs, regardless of whether settlement occurs in dollars, digital yuan, or a basket of currencies. Investment in productive farmland, integrated energy pipelines, and critical materials mining facilities become the new safe assets. Ficoirs priced not by fluctuating interest rates, but by their intrinsic ability to generate essential cash flow and tangible output. The investment narrative moves from financial engineering back to fundamental economics. Simultaneously, there must be a deep strategic resolution regarding monetary metals. Gold and silver, often dismissed as relics in a digital age, regain their central importance as pure, uncorrelated hedges against sovereign balance sheet mismanagement. Unlike Bitcoin, which remains volatile and structurally complex for institutional settlement, gold and silver possess 5,000 years of consensus as ultimate stores of value, holding no counterparty risk or jurisdictional liability. As global trade settlement increasingly bypasses the dollar through mechanisms like mBridge, the functional role of the dollar as the ultimate settlement medium weakens us, forcing central banks and large private entities to increase their holdings of an asset that stands outside the system entirely. This shift isn't about gold rising in value in nominal dollar terms. It's about gold maintaining its purchasing power as the dollar's ability to buy real goods and services is systematically eroded by inflation, the inevitable consequence of resolving the $318 trillion total liability through aggressive monetary debasement. The resolution to America's inescapable debt mathematics will not be a sudden, dramatic default on Treasury bonds. It will be a carefully managed, protracted inflation event, A slow-motion destruction of the currency is purchasing power designed to reduce the real burden of the accumulated debt over decades. The political reality is that raising taxes by 15% and cutting all government spending by 15%, the fiscal requirement to restore long-term balance, is suicide for any political party. Therefore, the path of least resistance is to inflate the debt away. The digital yuan accelerates this timeline by removing the external mechanism, forced dollar demand, that was previously subsidizing America's borrowing costs. It forces the inflation clock to tick faster. As interest costs consume more of the budget, the pressure on the Federal Reserve to suppress long-term yields through some form of financial repression or renewed quantitative easing becomes irresistible, regardless of the inflationary consequences. The market sees this coming, hence the rising risk premium on the 30-year bond. For the proactive investor, the strategy is one of deep de-dollarization at the margin, not abandoning the dollar, but reducing reliance on it as the sole guarantor of safety. This requires meticulous attention to the subtle indicators of systemic stress. One must track the bid-to-cover ratio at Treasury auctions, not just generally but specifically the participation rate of indirect bidders, foreign central banks. If the bids become shallow and the Treasury is forced to accept higher yields, that is the market signaling profound stress. Similarly, monitoring the growth trajectory of mBridge volume, if it exceeds $100 billion in monthly settlement, the transition accelerates exponentially due to network effects. The greatest error one can make now is to rely on traditional metrics of stability when the underlying geometry of the financial world has fundamentally changed. The mathematics broke when the cost of financing America's promises became dependent on optional, rather than mandatory, global demand. The digital yuan provided the optionality. The $38-43 trillion debt provided the imperative for global creditors to exercise that option. We are now living through the long, drawn-out consequence of that broken math, a gradual erosion of purchasing power that will redefine wealth transfer for an entire generation. The slow collapse is not a future event. It is the present reality unfolding in the quiet. Technical movements of central bank balance sheets and cross-border settlement ledgers, far away from the sensational noise of cable news, yet absolutely deterministic in its ultimate outcome.